How to outperform 99% of investors. Welcome to Be a Baby Billionaire. Navigating the world of investing can be both exciting and daunting, especially with the multitude of options and strategies available. However, mastering a few key principles can help you outperform the majority of investors and achieve your financial goals with confidence. In this guide, we'll explore 15 essential topics that can empower you to become a savvy investor. From setting clear goals to maintaining patience and discipline, each topic will provide valuable insights and actionable strategies to help you navigate the complexities of the market and build a robust investment portfolio. Whether you're a novice investor looking to get started or a seasoned veteran seeking to refine your approach, these principles will serve as invaluable tools on your journey towards financial success. So let's dive in and discover how to outperform 99% of investors with these essential principles of investing. 1. Setting clear goals. When it comes to investing, it's crucial to define clear and specific investment objectives that reflect your financial goals and risk tolerance. Whether you're aiming to build wealth for retirement, save for a major purchase, or generate passive income, articulating your goals helps guide your investment decisions and ensures they align with your aspirations. By understanding your risk tolerance, you can determine the level of risk you're comfortable taking on and tailor your investment strategy accordingly. Whether you're a conservative investor seeking stability or a more aggressive investor willing to accept higher risk for potential returns, setting clear goals allows you to focus your efforts and make informed investment choices that support your long-term financial success. 2. Developing a solid strategy. Creating a robust investment strategy is essential for achieving your financial goals and navigating the complexities of the market. A solid strategy involves conducting thorough research to identify investment opportunities, assessing potential risks, and formulating a disciplined approach to asset allocation and portfolio management. By aligning your strategy with your investment objectives, risk tolerance, and time horizon, you can build a diversified portfolio that balances risk and reward. Whether you opt for a passive index fund approach or an active trading strategy, developing a well-researched and disciplined investment strategy provides a roadmap for achieving your financial goals and helps you stay focused amid market fluctuations and uncertainties. 3. Staying informed. In the dynamic world of investing, staying informed about market trends, economic indicators, and geopolitical developments is essential for making informed investment decisions. Keeping abreast of relevant news and information allows you to anticipate market movements, identify emerging opportunities, and adjust your investment strategy accordingly. Whether it's monitoring stock market indices, analyzing economic reports, or staying updated on global events, staying informed provides valuable insights into market dynamics and helps you navigate investment opportunities and risks more effectively. By staying proactive and engaged with market developments, you can position yourself for success and make more informed investment decisions that support your long-term financial objectives. 4. Continuous learning. Committing to ongoing education and expanding your knowledge of investment principles and strategies is key to becoming a successful investor. The investment landscape is constantly evolving, with new trends, technologies, and market dynamics shaping the way we invest. By dedicating time and effort to continuous learning, you can stay ahead of the curve, adapt to changing market conditions, and refine your investment approach over time. Whether it's reading books, attending seminars, or enrolling in online courses, continuous learning allows you to deepen your understanding of investment principles, sharpen your analytical skills, and enhance your ability to identify profitable investment opportunities. By embracing a mindset of lifelong learning, you can become a more confident and savvy investor capable of achieving your financial goals in an ever-changing market environment. 5. Long-term perspective. Adopting a long-term perspective in investing involves recognizing that short-term market fluctuations are normal and focusing on the overall trajectory of your investments over time. By avoiding the temptation to react impulsively to short-term market movements, investors can stay committed to their long-term investment goals and objectives, allowing investments to compound and grow steadily over time. By maintaining a steadfast commitment to their investment strategy, investors can weather short-term volatility and position themselves for success over the long term. 6. Diversification. Diversification is a fundamental principle of investing that involves spreading investments across different asset classes, industries, and geographic regions to reduce risk and optimize returns. By diversifying your portfolio, you can mitigate the impact of individual investment losses and increase the likelihood of achieving consistent returns over time. By investing in a mix of assets such as stocks, bonds, real estate, and commodities, investors can reduce the overall risk of their portfolio while potentially capturing returns from multiple sources. Diversification helps smooth out investment returns and can provide a more stable and predictable investment experience over the long term. 7. Risk management. Implementing effective risk management techniques is essential for protecting capital and minimizing losses in investment portfolios. This involves identifying and assessing various types of risks, including market risk, credit risk, and liquidity risk, and implementing strategies to mitigate them. Risk management techniques may include setting appropriate asset allocation targets, using stop-loss orders to limit potential losses, and employing hedging strategies to protect against adverse market movements. By proactively managing risk, investors can reduce the likelihood of significant portfolio declines and preserve capital during periods of market volatility. 8. Avoiding emotional decisions. Making rational investment decisions based on analysis rather than emotions is crucial for long-term investment success. Emotional decision-making, such as panic selling during market downturns or chasing hot investment trends, can lead to impulsive and irrational behavior that undermines investment returns. By maintaining a disciplined approach to investing and sticking to a well-defined investment strategy, investors can avoid succumbing to emotional biases and make decisions that are based on sound financial principles and objective analysis. By remaining calm and rational, investors can navigate market fluctuations with confidence and stay focused on their long-term investment goals. 9. Sticking to your plan. Maintaining discipline and consistency in executing your investment strategy, even during market volatility, is essential for long-term success. It's natural for markets to experience fluctuations, but reacting impulsively to short-term movements can derail your investment plan. By adhering to your predetermined strategy, you can avoid making emotionally driven decisions that may undermine your long-term objectives. Whether it's sticking to your asset allocation targets, rebalancing your portfolio periodically, or staying committed to your investment timeline. 10. Seeking value. Identifying undervalued assets or opportunities for growth potential in the market is a cornerstone of successful investing. While markets may sometimes exhibit irrational pricing or overlook certain opportunities, diligent investors can capitalize on these discrepancies by seeking out value. This may involve conducting thorough research, analyzing financial statements, and assessing market trends to identify assets that are trading below their intrinsic value. By investing in undervalued assets, investors can potentially achieve above-average returns as the market recognizes their true worth over time. However, it's crucial to exercise caution and conduct proper due diligence to ensure that the perceived value is justified and aligns with your investment objectives and risk tolerance. 11. Active monitoring. Regularly reviewing and reassessing your investment portfolio is essential to ensure that it remains aligned with your goals and objectives. Markets are dynamic and subject to change, so it's important to stay proactive and vigilant in monitoring your investments. This may involve tracking performance metrics, analyzing market trends, and evaluating economic indicators to identify any shifts or developments that may impact your portfolio. By actively monitoring your investments, you can identify opportunities for optimization, mitigate potential risks, and make informed decisions to keep your portfolio on track towards achieving your long-term financial goals. 12. Adaptability. Being flexible and willing to adjust your investment approach in response to changing market conditions is crucial for navigating the unpredictable nature of financial markets. While it's essential to have a well-defined investment strategy, it's equally important to remain adaptable and responsive to evolving market dynamics. This may involve reassessing your asset allocation, reallocating resources to capitalize on emerging opportunities, or adjusting your risk management strategies in response to changing market conditions. 13. Avoiding herd mentality. Resisting the temptation to follow the crowd and instead relying on independent analysis is crucial for making sound investment decisions. Herd mentality, or the tendency to mimic the actions of the majority, can lead to irrational behavior and herd-driven market bubbles. By conducting independent research, analyzing fundamental data, and forming your own conclusions, you can avoid being swayed by emotional biases and groupthink. While it may be tempting to follow the crowd during periods of market exuberance or panic, staying true to your investment thesis and maintaining a contrarian mindset can help you identify valuable opportunities and avoid potential pitfalls in the market. 14. Seeking professional advice. Consulting with trusted financial advisors or experts for guidance and expertise can provide valuable insights and support in navigating the complexities of investing. Financial advisors can offer personalized recommendations tailored to your individual financial situation, risk tolerance, and investment goals. Whether you're seeking advice on asset allocation, retirement planning, or portfolio management, a qualified advisor can help you develop a comprehensive investment strategy and make informed decisions that align with your objectives. 15. Maintaining patience and discipline. Remaining patient and disciplined in your investment approach is essential for achieving long-term success in the market. Successful investing requires a steadfast commitment to your investment strategy and the ability to weather short-term fluctuations and market volatility. While it may be tempting to chase after quick gains or react impulsively to market movements, maintaining a long-term perspective and sticking to your investment plan can help you avoid costly mistakes and stay focused on your financial goals. By exercising patience and discipline, investors can ride out market downturns, capitalize on long-term trends, and ultimately achieve sustainable wealth accumulation over time. 16. Summing it up. As you embark on your journey to becoming a savvy investor, it's about understanding fundamental principles, staying disciplined, and continuously learning and adapting to evolving market conditions. By applying the essential topics covered in this guide, you'll be equipped with the knowledge and strategies to navigate the complexities of investing with confidence and poise. Whether you're aiming to build wealth for the future, save for retirement, or achieve other financial goals, staying committed to these principles will set you on the path to long-term success. So embrace the journey, stay focused on your goals, and remember that with dedication and perseverance, you have the power to outperform the crowd and achieve your financial dreams. Time for the soft question. What techniques and strategies do you use in your investing methods? Please share your thoughts and experiences in the comment section below. This will help everyone learn and grow together. Subscribe with us and learn. If you find the information in this video valuable, please subscribe and share it with family and friends. Your support will help us create many more high-quality videos like this. Please support us. Hit the like button and the notification bell to be notified. Click on these 2 videos shown here to explore even more. The contents of this video are for educational and informational purposes only. Thank you for watching.